Hello, Mark Ostwald from ADM Investor Services International, and this week I'd like to have a look at the low volatility environment that we find ourselves in, and above all how things are likely to pan out over the next 3 to 4 weeks, when we're also going to go into a very low liquidity regime. And by that I mean we've got the 2 weeks of Easter holidays. They are followed very swiftly by the May Day holidays around the world. We have the longest ever Golden Week holiday in Japan, which will amount to 10 days, and thereafter we've got Ramadan. So we're in an environment where we may be in low volatility, but if we get any surprises, we're also in low liquidity. The best example of low volatility outside of the falls that we've seen in bond and stock volatility is actually sterling. And this, I think, is quite instructive about where the market's perceived risks are at the current point in time. What we've seen in sterling is obviously there was heightened volatility as we went into these two big dates of March the 29th and April the 12th. But now that we've kicked down the can down the road to the end of October, so we saw yesterday volatility drop right off the face of a cliff. And that goes hand in hand, I think, really with the idea that markets now perceive political risk to be much more subdued than they did at the start of this year, and indeed for much of the back end of last year, because they feel that the US will eventually conclude a trade deal with China, and therefore we can now start more happily reaching for yield. So let's have a look at our next chart to actually highlight a point about the mistakes that both the Fed and the ECB have made. In terms of the Fed, we've been in a situation where in Q4 they made the cardinal error of ignoring one of their key indicators, financial conditions, which tightened so much thanks to heightened volatility, higher bond yields, wider credit spreads, and greater volatility, that they were so focused on getting the Fed funds target to 2.5% that they ignored this and have since obviously had to change tack very, very sharply. In the ECB's case, they basically were so focused on ending QE that they ignored the fact that there were a lot of slowing economic indicators in the euro area. So where does that leave us? Obviously, with looser financial conditions and low bond yields, the need to reach for better returns elsewhere is all too obvious. But is this actually the right way of looking at things? If we turn to the outlook for the US Fed funds rate, at its nadir in terms of people's expectations being so low for the global economy, including the US, we were pricing in a 75% chance of a rate cut by December. We've now priced that back out to about 50%, quite rightly so. And I think the bigger risk is when we look at the next chart of the Atlanta Fed GDP Now estimate, which at that low point of 75% chance of a rate cut was just at 0.2%, suggesting very weak Q1 growth. We're now at a level where we're probably at 2.3%, where we're probably looking at the sort of growth rate that we're likely to see for the whole of the year, which people may say is a lot slower than last year, but is actually slightly above the US's potential rate. So we're in a situation with unemployment being as low as it is in the United States, inflation around target, that actually at some stage, if we get better economic data coming in, we will have to make quite a sharp change in terms of what we're pricing in terms of the next Fed rate move, which might actually be a hike. Not necessarily this year, but perhaps at the beginning of next. And that will have obviously implications for emerging market FX, which has been extraordinarily popular, and indeed for all this reaching for yield. And in the current environment where we've got a low liquidity regime coming up, there may be the odd surprise on the upside economically, which jars what financial markets are currently doing, and may actually have some shock waves going into other asset classes.